Pfizer has had a rough start to start 2025. The company's revenue declined in the first quarter by 6% year over year, mostly due to lower Paxlovid sales as the result of the changes in the IRA Medicare Part D redesign. But the company reaffirmed its full year 2025 revenue and profit forecast. So the first quarter of 2025, while it was not great from an investor standpoint, it was in line with what the management team was expecting and forecasting to investors. So this was already to be expected. They also have some catalysts coming up in 2025, like some readouts, some regulatory decisions that could lift the share price. And of course, Pfizer stock investors are very attracted to its nice dividend. And so there are reasons to evaluate Pfizer stock right now, I understand. And so I wanted to share with you my analysis of Pfizer, longer term revenue growth, profitability, and then share with you my proprietary discounted cash flow valuation of Pfizer. Bring it all together to answer the question if I think this stock is a buy right now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Pfizer's revenue over the previous 2 decades has been volatile, to be sure. Uh, Jumping, of course, to $101 billion in revenue in 2022 as the company benefited from the COVID-19 vaccine sales and treatments, including Paxlovid. And so it was, sad to say, kind of, but it was a beneficiary of the COVID-19 pandemic in that its sales absolutely soared. But since then, its sales have declined, but they're still at higher levels, right? Sales fell to 59.6 billion in 2023, and they're up to 62.5 billion in 2025, which, if you go all the way back, it was better than all the revenue it generated in any year, going all the way back except for 2010. So its revenues are not crashing back down all the way where they were in 2018, 2019. But of course, they're not going to be at 22 levels for a long time. So revenue growth, not that great for Pfizer, and I don't think investors are expecting very much revenue growth from Pfizer over the next few decades. The return on investor capital is a metric I like to consider when I'm evaluating a business because it shows me how good a company's management team is at taking investor funds and turning it into products and services that generate profits and cash flow. And you might say, well, the company is actually giving back money to shareholders. They're not taking money from investors. Well, I will argue that any money that a business keeps and doesn't distribute to investors, or I should say any profits a business keeps and doesn't distribute to investors, they're using investor money because you're entitled to that money. If a company makes $100 in profits and they only give you $50 in dividends, that means they're keeping 50 of your dollars. You're entitled to that. And how good they are at reinvesting those profits is calculated in this return on investor capital metric. I like to see an ROIC that's larger than the company's weighted average cost of capital, and the larger the difference, the better for me. I also like to see a trend line that's improving. I don't see that with Pfizer in terms of the trend line that's improving. I only see a volatile trend line that goes up and down. I don't see a consistent improvement over recent years. So when I compare Pfizer's return on investor capital, which was over 9%, to its weighted average cost of capital of 7.74%, it does exceed at least the 1-to-1 ratio that I like to see on businesses that are not demonstrating an upward trend. If they are demonstrating an upward trend, I don't need to see a 1-to-1 ratio because the company is demonstrating improvements and is not settled at its longer term return on investor capital number. The cost of debt here is 7.5%. The cost of equity is just 7.9%. Healthcare companies, as I've mentioned before, they're not strongly correlated to the macro economy, meaning their sales don't depend on your job prospects. Their sales don't depend on how much money you made last year. Their sales depend on how much you need their medicine. And medicine is not something people uh, choose or don't choose based on their income. Medicine is something people choose when they feel like they need it. And the situation financially almost has zero influence on that purchasing decision as long as they can afford to pay for whatever it is that they're paying for. Sometimes people would love to buy it and if they had the money, but they just don't have the money to pay for it. So in those cases, uh, it can be correlated to some degree, right? That's why I don't say that there's no correlation to the macro economy, but it's much less correlation to the macro economy compared to a company like Ford or General Motors, which are strongly correlated, right? If you're not working or getting a promotion, you're not interested in buying a car when you're unemployed, right? So that's the difference. And that's why investors are attracted to healthcare stocks because of this one primary reason is the industry attractiveness to healthcare companies. So the outcome of my calculation has Pfizer stock valued at $68.70. The current market price is just $23. So according to my DCF, it looks undervalued. And then when I go to finchat.io to get the forward price to earnings ratio, at a forward PE of 8.3, it's near the cheapest it's been in the last decade. So it looks cheap on this metric as well. So regardless of the metric I'm using, Pfizer stock looks undervalued and it has some catalysts in 2025. It has that multi-billion-dollar cost saving plan. And of course, that dividend is attractive to be sure. So I last updated Pfizer stock on December 31st, 2024, and I rated it as a buy then. And I'm rating it as a buy now on May 20th, 2025. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.